it's obvious that the market's going to be dragged by yields.
Yeah, absolutely. And that's been the case. There's been a pretty good correlation, pretty high correlation with yields. Look, I think we've got some respite now from major auctions over the next couple of weeks, but that's going to be the story. There's plenty of more supply to come. And when you turn China and Japan, our biggest holders, into net sellers, or at least less interested in buying debt, then you're going to see more auctions like this. Look, I think the market right now, near term, is going to trade in CPI and PPI next week. And if those numbers show continued relief from inflation, market will continue to rally. Powell, I think, struck sort of a neutral tone, slightly more hawkish than perhaps the market wanted. And that, in conjunction with what yields did, caused the pressure yesterday. Plus, let's not forget, we were on a very long streak, so a bit overbought.
Yeah, exactly. It was sort of primed.
Yeah, it was
primed for a little bit of selling. It's just the bond auction really got the ball rolling on the spike in yields. I mean, we made a bunch of walls and some graphics to show you exactly the difference in what the Fed chair said on Fed Day, November 1st, and what he said yesterday. And I'll show you those in a minute when we try and, decipher whether it was really more hawkish or not, if we're really under the threat of another rate hike or not. How do you see it?
I think he's trying to buy time. And if I were Jay Powell, that's what I would do too, because he just needs to let this economy kind of play out. So he doesn't want to commit to anything, nor should he. We know that the market and the bond market, the economy, the stock market is doing a lot of work for him. So time is his friend. And if he can kick the can and be non-committal, then that's what works. But when we're talking about, rates are higher, that's why the market gave it up a little bit yesterday, rates are lower. We need to really remember why. Why, when rates are higher, does the market go down? Because when rates are higher, people are willing to pay a lower valuation on the market, and vice versa. So even today, we're at 18 times. That's a pretty rich valuation. A couple years ago, when rates were really low, the best we got to was about 21 times. So I think we've got a limited upside here, and Jay Powell is just looking at it thinking, time's my friend. Let's let the market do the work for me.
I mean, the market, aside from the knee-jerk pile-on from the bond auction, doesn't really think there was anything different, because December, January, March, the probabilities, if we were to show you the bar chart there, they barely budged. We're talking teens probabilities of another hike. But let's get to the idea that somehow the Fed chair was more hawkish yesterday, and now we need to be on alert, or somehow the goalposts have moved again towards a hike. Because yesterday he said, quote, "If it becomes appropriate to tighten policy further, we will not hesitate to do so." Well, what did he say on Fed Day, November 1st? Evidence of growth persistently above potential could warrant further tightening of monetary policy. That's no different. Yesterday, inflation, quote, "well above target, has a long way to go." On Fed Day, inflation still running well above our 2% target, has a long way to go, near word for word. Not convinced yet? Well, yesterday, not confident that the Fed has achieved a sufficiently restrictive rate. Ongoing progress to 2% goal, not assured. Well, Fed Day, committed to achieving a stance of monetary policy that's sufficiently restrictive. Not confident yet that we have achieved such a stance. Again, near word for word. Meeting by meeting, said it yesterday, so we're going meeting by meeting. That's what he said on Fed Day. And finally, yesterday, we will continue to move carefully. Well, what did he say on Fed Day, November 1st? The committee is proceeding carefully. I think, Josh, it was this auction that got everybody unnerved, and then we're just looking for excuses that somehow the Fed chair was more hawkish or not.
Yeah, I think that's right, Scott. I would pay more attention to the auction for actual supply, demand, and market dynamics than I would to anything the Fed has to say. Recall that at the end of 2018, the Fed was saying they are nowhere near finished hiking rates, and within 30 days they would begin the first of 3 rate cuts to start off 2019. In September of 2021, the Fed's own forecast was that they would hike rates once in 2022. Instead, they ended up pursuing the fastest, steepest rate hiking cycle ever in most of our lifetimes. And so that kind of stuff is not important to me. I think the market reacts to it temporarily, and then very quickly everyone forgets and they just go buy Microsoft. That's the dynamic right now. So yeah, it's unnerving. We don't want to see Treasury auction that people don't bite. Okay, I agree. But so far, none of those auction days have done lasting damage to the bigger uptrend that we're seeing in large cap tech. And that's really going to determine whether or not we finish the year strong, much more so than anything Powell has to say at this point.